So this is, as far as the year goes, probably the most important of our Mat Chats. We're coming up on our first Fed rate cut, which we've been talking about for a while. And there's a lot of things coming out during this time period that are probably going to send us into a significant market decline. So with that, we'll just jump right in. If Tracy can get the slide to switch.
There we go.
As usual, we'll have our normal market, treasuries, economy, Fed, and alts conversation, and then some updates. Jumping right in, the market is going to be a significant section of what we talk about today. So over the last month, despite the volatility we've had, the market is up over where it was a month ago. I do believe that we've probably hit a high on the market for the year and maybe for the next couple years. We could theoretically see a increase through the end of September, but I do think we're very close, if not there, as far as the peak in the market. So I'm going to show you a series of charts here and try and explain them in a way that makes sense. So this is the S&P 500 with yield curve inversions. So a yield curve inversion is when short-term bonds are paying higher interest rates than long-term bonds. And that's a fairly uncommon thing to happen. But generally, when that does happen, it precedes a drop in the market. And you'll see we've had a very protracted or long period, this last section, of inverted yield curve. So to give you an idea, the long-term treasuries might be paying 4.5%, while the short terms are paying about 5%. And that is because people suspect that interest rates are going to go down. And so they're getting into long-term treasuries, as we have been, to take advantage of the principal appreciation there. So we have this inverted yield curve, and what's likely going to happen is we're going to see the market drop and the curve revert back to the mean, where long-term treasuries are paying more than short-term treasuries. Okay. Now, what's really important, and this is a good chart to kind of explain what revision to the mean, or going back to what the average return or normal return on the market should look like. The dotted line would be that trend line that shows a normal growth rate. And you'll see we are way above that normal growth rate. And historically, what happens is the market will revert back to that line, oftentimes dropping below it, but staying much closer to the line than we are right now. So you'll notice 2000 and 2008 were both above the line and then dropped down to and below the line. Same thing I expect to happen here. So that's a significant drop from where we are to come down to the line and below the line. And I do expect that we are there now. Next, we often talk about Warren Buffett, and he, by the way, has more in cash, both in dollars and percentage, than he's ever held in history. And as part of his cash position, he is the largest holder of treasury bills, which are short-term treasury notes, 30, 60, and 90 days, because he expects this market to drop. He wants to have as much cash on hand available to take advantage of it. So right now we are 2 standard deviations above the norm. That very rarely happens, as you can see. And when it does, it usually results in a significant drop. So that's where we stand right now. So the indicator that we've been using to look at the overall value of the market is the Shiller PE. And as we've talked about for years now, the kind of the bar for overvalued is 25. So the line to the left-hand side, when you see 25, it has only exceeded that 25 4 times. 1929, Great Depression, 2000, dot-com bubble, and 2008, and then where we are now. And so at 34.77, the mean is 17 on this. So we're more than double normal currently. So I do expect we're going to see that drop significantly. And what is going to cause that is the Fed cutting interest rates. They are going to cut on the 18th. Now the question is, are they going to cut a 1/4 point or a 1/2 point? And I'm even hearing whispers that they might do a full point. A 1/4 point, I think you get a market drop because the smart money, quote unquote, would consider that not enough. A 1/2 point might be considered the right amount, and a full point cut would be considered things are worse than we thought they were, and that would make the drop happen sooner. Ultimately, I think what we're talking about is a V-shaped recovery versus a U-shaped recovery. So 2008 is an example of a U-shaped where the market came down and stayed down for a while, and it took a few years until it fully recovered back to where it was. And personally, I think the Fed has to be extremely aggressive in their cuts to avoid another U-shaped recovery. I think they need to push things down sooner than later. And so that means aggressively cutting interest rates. That does 2 things. One, if interest rates go down, as we're seeing in this US Treasury, long-term Treasury, the current yield is around 4. If the Fed cuts interest rates and that in turn causes these bonds to go up and yields to go down, your long-term treasuries go up in value, and that's what we anticipate happening. It also would likely draw the stock market down. So we want to be taking advantage of both. We want to have interest rates come down and have your long-term treasuries go up, which you guys have been seeing over the last couple months. And I anticipate you're going to be seeing that through the end of the year, as we've been talking about. But there are some things that we need to be aware of as the market does come down. Oftentimes what you see is a sell-off that affects all asset classes. And that does 2 things. It can create some fear. If you see what we consider protective assets, like these treasuries, like your gold and silver, if you see those come down when the market comes down, it may be concerning. Um, so I just want you to be aware that that's likely to happen, that everything comes down in a short period of time, but then the safe assets begin to start going up while the stock market continues to go down. And that's a trend we see quite often. The reason we continue to hold the assets, despite knowing that that's likely to happen, is we don't know at what point they turn around, and we don't know to the extent they turn around. So we want to be holding them despite knowing that there's probably going to be some decline there. And it should be a relatively short-term decline. But what that also does is create opportunity. So if, for example, long-term treasuries go down in value despite interest rates going down, that tells me there's a value gap there, meaning there's opportunity to buy them at low prices again, knowing that in the short term they're going to bounce back up. And we see that opportunity happen quite often in this type of scenario, where the bonds may go down by 10% despite the value of them theoretically increasing because interest rates have gone down. So that gives us an opportunity in, usually it's a day or two, to shift into those and take advantage of that drop. So I tell you that, number one, because I probably will not be able to call everybody when it happens, because it is such a short period of time, that if that opportunity happens, I want to be able to just take advantage of it and increase the holding in those long-term treasuries. No guarantee that it happens, but what I do want to do is anybody that I haven't had a account review with in the last couple weeks, I want to try and squeeze that in the next 2 to 3 weeks to make sure we're on the same page with all of this, knowing that it's likely coming. Okay, long-term tips. Same kind of scenario. You'll see the interest rates at 1.6. As interest rates go down, you're going to see the value of these go up, which has been happening. You're going to see the same kind of thing where they could drop in value on the market as an opportunity to add to the position, at least in the short run. Where I do see these doing well, in addition to interest rates going down, is as the Fed starts to cut interest rates, we should see inflation start to rise again. So you'll start to see these bonds not only go up based on interest rates going down, but you'll see their interest rate go up because it's tied to inflation, which also makes them more attractive. So the price goes up. So we have that component of the tips as well that I see kind of accelerating at the beginning of next year. So one of the things that came out since our last call was, as we've been talking about the whole time, the economy, the jobs numbers have been fudged throughout this last year to make them look better than they are. And we actually had a reduction of 818,000 jobs, which is an all-time high. I believe previously we had as much as 500,000 jobs adjustment, but they reduced the overall jobs by 818,000, which is a sure sign that the economy is weaker than what was being reported. And I think we're going to see that kind of play out after the election this year. possibly before the election, but certainly after the election. And finally, we got to tick down into the higher chance of conservative Fed policy, which means they are definitely going to cut interest rates this month. In my opinion, as we've talked about before, they actually should have started cutting interest rates last year when we started to have banks fail. And we talked a little bit about that. I believe they've waited too long to avoid a significant recession. And so they still have a chance to soften the landing and have it be that V-shaped recovery, but I don't have a lot of faith that that's the direction we're going. So, uh, but finally, we are going to get some movement there. And going to the alternative investments, as I said, gold is likely going to go down. Silver is likely going to go down initially when the market comes down, because you have folks that go, oh, it's awful, I'm selling everything. And that drives everything down, at least in the short run. And then it creates an opportunity to buy things at lower prices and hedge against the market going down in the future. So I do anticipate both gold and silver being available at lower prices. I don't know that we will get the same spike, 1 or 2 day spike that we might get in the long-term treasuries. I think it might be a little bit more protracted or extended, and so it won't be such a rush to maybe make some changes there. Oh yeah, so we did have a change in staff recently. Mindy is no longer with us. So you likely will be hearing from Laura. Some of you have heard from her in the background, and or Skylar, who will be helping out with any paperwork and those sorts of things. And of course, Lynn will reach out to you for scheduling and all of that. So one of the things I wanted to say is we have been talking about this moment, this potential event, for a couple years now, with signs that it was close, and then fiscal policies that pushed it down the road, potentially and likely making it worse. We're there. It's imminent as far as I'm concerned at this point. It's a question of whether it happens over a 2-year period or a 6-month period. I don't know, but we're there. All the signs are showing that it's time. So I don't want that to be a scary premonition. I want it to be an opportunity, because there is a big opportunity to jump into the market like Warren Buffett when the time is right. So thank you for the birthday wish, and thank you for sticking with us. We'll talk to you all soon.